Here on the third segment, we really want to go into what is happening with the global floating storage and how are things shifting about, just because prices are starting to come down in some areas, remaining elevated in others, and it's obviously shifting underlying flows. So when we look at tanker rates, the tanker rates for product tankers continues to be elevated. And I think this is important because when you look at miles per ton, and we've talked a lot about this on the oil side, but we haven't given enough information on really the product tanker side, because there's miles per ton is how many miles is it shipping? Is it sailing to? You know, going from the U.S. to Europe is easier than going from the U.S. and shorter, I should say, than going from the U.S. to South Korea. So when you look at the fact that Russian crude is going from Russia all the way around up into India, into China, you have a much longer trek than you would normally would. But the same can be said about product tankers, because now you have new flows in terms of where some of this is going. Like the Middle East is buying a lot of product from Russia. You know, then it's turning around, taking that product and then sending it into the international market, and/or really into Europe, which is, and then from India is taking a lot of this Russian crude and then exporting a lot of this refined product that normally doesn't go, or I should say not to the same degree, goes into the European and US markets or the Atlantic basin in general. So you just have miles per ton increasing, which means that ships are on contract, are really booked up longer, which is then creating this increase in price. But by increasing the price, you also shut the ARB, because some of the ARBs, or I should say some of the ARBs get shut because the price of moving it just starts to price itself out. And that's some of the things that we're seeing between what is coming from Europe into the US on the gasoline front. Now, one of the key things that we had been talking about prior to the Saudi Arabia announcing what their price would be on the official selling price, it was what was Middle East storage doing. And one of the things that we had highlighted was that storage was starting to creep back up. We had started to see this movement higher, and that was when we looked at this and said, look, they're going to have to not so much pause, but just not surprise as much to the upside on some of their OSPs. And we were wrong, and they decided to take OSPs much higher. Not as much for the US and Europe, but for Asia. But by doing that, you already have Asia that's been absorbing a lot of new product and crude from Russia. And West Africa has started to try to get more and more competitive. And then as you had the spread coming down between Dubai and Brent, well, that just made Middle Eastern crude all that much more expensive. And here you can see it's resulting in more and more product being left in floating storage. And just given the backdrop that we're seeing, it's unlikely that we are going to see this adjust anytime soon, given the headwinds. Now it'll come down. It'll be volatile, but it's just what we're seeing is we're going to get more crude in floating storage in the Middle East than we normally do, especially as we come into the end of August, beginning of September, where obviously taking out 2016, that red line, you can see that there's normally this drop down. We just don't see that, just given what the pricing dynamics are and how that is playing out in the system. And this is just looking at Dubai versus Brent, where you can see it's just at about $6.11. And you're seeing, again, that downward pressure in terms of how competitive is Dubai with Brent. And when you look at where Dubai is, so if Dubai is $6, or if Brent is $6 more expensive than Dubai, but then you have Saudi Arabia that sets their price $10 above Dubai, well, you're losing $4, or, and obviously factoring in shipping and insurance, you're losing about $1.80 to $2 by buying Middle Eastern crude versus Brent. Or if you think of it a little bit differently, if you then put $10 above Dubai, which is $4 above dated Brent, but then you look at the Nigeria, for an example, or the or other parts of West Africa, they're only $1.60 above dated Brent, well, all of a sudden, West African crude becomes more competitive versus what's happening in the Middle East. And that's where you're going to start to see some of these shifts. But it's also going to come down to what are people trying to make. And the distillate cuts are going to continue to trade at a premium. Now, when you look at crude oil on the water, it still stays elevated. As we've been saying, it's going to remain high just because of miles per ton, more cargo sitting on the water. This is going to keep things fairly elevated. And then oil in transit, obviously, is a volatile number. But again, that will stay high as well, especially given where we were in 2017, where you can see the pink lines were staying elevated. Again, we're just going to stay at the highest end, either setting new seasonally adjusted highs or at least setting or just sitting at the top end of the range. Now, when you look at floating storage, you can see that we're tracking up along the lines of 2021. This is kind of right in line with what we were saying, where we just expected to follow the 2021 path. The slowdown, as we talked about in segment 1 of Chinese buying, is going to put a little bit of a damper on this just because we're going to get some of this crude moving through. But so Asia could come down a bit, but the Middle East is going to be the interesting one to watch because that is going up. And as that goes up, well, it should be no surprise, West Africa is coming down because people are buying more from West Africa, leaving more in the Middle East. And that's going to be an interesting dynamic to watch and to see how that unfolds over the coming few weeks. Now, when we look at Asian floating storage, here's that increase. Again, we think it's going to trend closer to 2021, but given the amount of crude sitting in floating storage, sitting in onshore storage in China, the renewed lockdowns, the slowdown in refining capacity, if there's going to be a matter of how much are they purchasing, are they purchasing any more, or are they going to slow down purchases? And right now it looks like they're slowing down purchases. And so by doing that, we should see a little bit less in floating storage just because there's nowhere to put it. They just don't have the space, nor do they need it. And that's going to kick some of that crude back into the market that normally would flow into Asia. And here's just another example where you're getting some of the utilization rates coming down in China. It's still small. It's still fairly normal and above the average. But the renewed slowdown is putting, again, some of that under pressure. But they've already purchased some, so you will get some cargo showing up that will go into floating storage. So that's why we're saying it's not going to drop like a rock, but it's unlikely now to get back to those 2021 levels just because of the slowdown. And again, that internal pressure that we continue to see within the Asian markets that we've talked about extensively on the economic show, especially in the Chinese section. So here's where you look at West African floating storage. You can see that we've dropped down back into the normal range. And a lot of this is driven based on the pricing with the Middle East, the pricing with the market. And this is and also another reduction in exports. But as that's happened, even if they've taken down some of their export expectations, they've also cut pricing. So cutting pricing mixed with Brent, the Brent Dubai spread tightening a bit, and the elevated OSPs coming out of the Middle East has pulled more of this into the market. And here's the super tankers going into China, remaining at the 2017 lows. And as we said, we don't see that changing just given the pressure that's internal, the issues in terms of onshore storage, and just the lack of demand within the market. So now when you look at exports, there was a big bounce in gasoline of 286,000 barrels per day. That's 483,000 barrels above the 5-year average. So as we were saying, that is going to remain elevated. We do think it comes down a bit just because there is that lumpiness, and we've seen it now in crude oil exports, crude oil imports. As that works through, again, as we said, we want to average it out. Distillate came down 341,000 barrels a day. That's 61,000 below the 5-year average. That's something that we think stays in this range just because their PADD 3 is trying to manage what is in storage, what can go up through the Colonial Pipeline, what can go on to a Jones Act, and then what can go into the international market, because there's a very healthy distillate margin to be made, especially when you look at the international market where a lot of this can exit into. Propane, propylene staying strong, up 83,000 barrels a day, 475,000 above the 5-year. We don't see that changing. Total crude oil exports, lumpy. We thought it was going to go up again. Instead, it fell 1.4 million barrels. Again, a lot of this is timing. We've already talked about how there's been buying out of both Europe and Asia. That's still the case, so that will go back up. Again, that's more timing. Gasoline exports, you can see breaking to new all-time seasonally adjusted highs. Not the highs ever, but highest so far in 2022. This is something that we had said was going to stay at the top end of the cloud, either making new all-time highs or just staying at the top. This was a bit outsized, so we do think it drops back down, but just back within the top of the cloud, still above the 5-year average. Maybe it overshoots below the 5-year average, but again, when you average it out, it's going to remain fairly healthy. Now, U.S. distillate exports, as we were saying, it's going to fall back within the cloud, still remain above the 5-year average, but much closer to it as we progress through the rest of the season, the rest of the summer, because I think the concern is now going to pivot to how much do we have available as we come into the shoulder season, as we prepare for the heating season. Ethane exports, lumpy, but again, as we said, still staying at the highs. We don't see that changing at all. And then when you look at crude oil exports, coming back down to that average, but as we always said, it's important to look at the 4-week, and we're currently sitting at 3.48 million barrels a day. We still expect to stay at that elevated level with propane, propylene breaking to those new highs. Now, when you look at Russia had in July, they had it at about 4.157 million barrels a day slated for export. We know that about 3.8 to 3.9 actually made it. So there is a certain amount that gets then kicked into August. So you're already starting at that elevated number. Angola sitting at about 1.184 in September. It's been some of that slippage already from August to September. Nigeria, something similar. Libya, you can see here, is back to over 1 million. We don't see it getting, we see it staying in this level. We don't see too much. There's still some tense standoffs, if you will, within the country, which we don't think is going to adjust anytime soon. So that's going to be one to watch, while the other areas continue to add. Vital lowered its offer of Dahlia crude for early September delivery to Europe for a 4th time. U.S. imports of Nigerian crude advanced to a 5-week high. We see that staying elevated as well, which again is helping move some of that crude out of floating storage and into the U.S. markets, which we don't see stopping. Vital offered 500,000 barrels of Dahlia that at $1.60 above dated Brent, which is down from $1.90. It was at $2.35, $2.15, $1.90, $1.85. Now it's $1.60. So again, you're seeing that they're trying to get more competitive and get this into the market. Crude in Europe had dropped to the low that it was at in 2014. The issue now is the Rhine River. How are they going to get things moving through? There's a huge issue in terms of just the amount of trade that can happen. We're going to talk more about it in the Econ show, just because this is going to be more than just something that's going to impact oil and refined products, but really trade in general, which is going to be a big overhang when we're looking at supplier delivery times and just cost. Because the issue is, as the Rhine falls, not only do you get shutdowns between specific points, but you can't fill the ship to the same degree. So that just means that the cost is going to be spread around less product, which is going to increase the cost in general. And here's just one of those examples of areas where the recent levels have dropped significantly. And I think it's interesting when you look at some of the areas coming off the North Sea and how those problems continued. Coal-fired power plants, steelmakers, and other industries in the ruhr rely on the Rhine for receiving raw materials. The water level at this critical passage in Frankfurt dropped to 49 centimeters. At 40 centimeters, it is considered uneconomic to sail there. So again, you're seeing a significant amount of drops that, again, I can't stress enough how this is going to impact the European economy, especially Germany, from all points in terms of just cost of doing business, electricity prices, raw materials, oil, natural gas, gasoline, distillate, gas oil. So this is going to be an important one to watch. And just to put it into perspective, on Germany's Rhine River is close to becoming effectively closed. When you look at the average and then the water level at the Rhine in meters, you're seeing just how slow. So level at which the Rhine is effectively impassable, we are creeping to that point. And once it hits that, the whole thing shuts down, becoming an even bigger problem. Gas oil had a small build of 3. So again, still small. Gas oil, distillate in general, still in a massively bullish backdrop. Gasoline had a small draw of 69, but again, you're still at a record amount. So when you turn to gasoline, we're just below where we were in 2020, but you can see just how elevated it is and how we normally get this drop down. But as we showed in segment 2, Europe is moving in the wrong direction on gasoline demand. It's actually dropping off fairly hard, and that's going to, again, keep more gasoline in storage. But the question is, can they export it if it's stuck in the middle of Germany or in other areas that can't get to the Rhine and get moved into the international world? As fuel oil continues to creep up, this again becomes a bigger issue because fuel oil was being exported into the Asian markets, especially high sulfur fuel oil. So then, if it can't get through, it gets stuck in the market. If it can't get recracked, then you see this continuing to push up, and you can see that where 2020 is, which is that yellow line, and 2021, that green line. So this is the third most, seasonally speaking, of fuel oil that we've ever had. And the two components that we're competing against are not exactly the best in terms of demand. Singapore had a drop. It was 43.8 million prior, dropped to 42.1. But again, the drop was driven by middle distillate and residual fuel. So you can see we're hanging out right at the average. But gasoline built. It built by 300,000 barrels, and that's the ongoing problem. When you look at at light distillate or gasoline naphtha, they're at a record high. This is the most that has ever been. Obviously, there was that one-time higher in 2020, 2 weeks ago. But when you look at this year, you're seeing more and more get pushed back. Now there's another more cancellations on some flow. That is all coming out of both Malaysia as well as Vietnam. So when you look at the international on the middle distillate side, you can see that, again, it's still very low. We don't see that changing. This is supporting the margin, which is why you're getting more gasoline just getting thrown into storage. But at some point, the economic run cuts start because you have nowhere to put the gasoline, or you're selling the gasoline at such a discount just to try to keep the distillate flowing that run cuts will get rolled out. All the while here you can see the residual, and remember, as middle distillate and diesel prices go up, countries like in Central Asia turn to high sulfur fuel oil and things to just try to get rid of it. And I think this is a big piece where you're continuing to see this get thrown, move through. And this should support more flow of fuel oil from Europe into Asia as the electricity burn. You get that flipping from middle distillate to the high sulfur side. Now on the total products on Fujairah, they came in at 24.1 million, a rise of 725,000 barrels. And this is the highest level stocks have been since December of 2020. Just to give you an idea, the last time they were here in December 14th of 2020, they had 24.63 million. The stocks movement saw a build across all three stock categories. So again, you're starting to get to a concerning point when we're looking at the Middle East, and it speaks to more about the demand going in, not only just internally, but also going into Asia, because the middle distillates can still flow into Europe. Costs are obviously high with the price of refined product or clean tankers, But again, you're starting to get to this point where they should be moving. Light distillate rose by 26,000 barrels, as at 7.62. East of Suez gasoline complex was under more pressure as concerns grew again for weakening demand and sentiment. Malaysia is the biggest one that had some cancellations on their imports. Demand is continuing to fall, especially as the school holiday period ends. Middle distillate rose by 330,000 barrels, coming in at 3.638. East of Suez gas oil complex was seeing strong selling interest with a steady pace of sell tenders issued by market participants. So here you're starting to finally get a little bit of that pivot where East of Suez is starting to sell some into the market, and you're starting to see some of that industry. Sources have noted that the Indian refiners, which frequently export diesel cargoes, may benefit. So again, India is still pulling more out. Meanwhile, unviable arbitrage to the west is weighing down cash differentials of cargoes loading in the Arabian Gulf and west coast of India, with swing barrels mostly pointed east, where high outflows from countries in Northeast Asia is already keeping the market well supplied. So you're starting to see the pivot. But again, the margins are still there. You're still going to produce middle disty. Stocks of heavy resid rose by 369,000 barrels to 12.85 million, holding above 12 million for the sixth consecutive week. Trading activity for bunker in the port of Fujairah was slow at the start of the week. However, supply disruptions were easing, so we should start to see that balance out a bit. But you can see that there's still that demand crunch that is happening. The time spreads for October, November coming down even more, back down to where it is. And it's showing just some of that balancing act, if you will, in terms of what is happening in the crude markets. But we still think that there's enough support to get Brent back to and over $100. And then when you look at North Sea, again, there's just been more of that pull through. This is something that we think is going to stay fairly low, especially given the tightness in the market for some of these grades. But that's going to be one to watch as we head into the end of summer. While European crude oil floating storage came down, there's a bit of that timing delay where it came down but hasn't quite hit the onshore side. So we do think that this is going to flip, where you get the drop here, then you'll get some the builds on the onshore, but you're going to continue to see that timing delay as product tries to move into the system. So that's what we have for you today. If you have any questions, you can find me in the comment section or on Twitter. And we appreciate you watching us. Thanks again. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.